see, private debt, the private sector's been deleveraging. It's now down to about 100% of GDP. Total debt is still about 340% of GDP. When we get to private debts, it's about 120% of GDP and has been falling, which is good. But total debt has offset it, the public debt. The government has actually taken on the debts as the private sector's delevered, because it's trying not to let the deleveraging slow down GDP any further. It has increased debt.
Hey guys, welcome to Everyday Finance. According to Raoul Pal, we are witnessing one of the biggest financial revolutions in history. One that not only generates riches, but also reinterprets money itself. Even while cryptocurrency is currently valued at $4 trillion. It is still quite small in comparison to $400 trillion in real estate, $300 trillion in global debt, and $100 trillion in stocks. Pal contends that this disparity will close quickly. By 2032, he expects Bitcoin to overtake the $20 trillion market for gold and the whole digital asset field to grow to $100 trillion, propelled by the same network adoption curves that propelled the development of mobile and internet technology. He views cryptocurrency as the biggest macro trade ever, a force that attracts talent, wealth, and innovation at an exponential rate rather than just an asset class. Digital assets prosper through network expansion and scarcity, while traditional assets deteriorate due to monetary devaluation. According to Pal, this is the moment when traditional diversification strategies fall short and the network effect of cryptocurrencies seizes a sizable portion of the world's value, transforming the financial system for many years to come.
So this work comes from Global Macro Investor. Global Macro Investor is the research service I started 20 years ago when I left managing a hedge fund. Over time, I've always used the business cycle framework, but we've developed these secular theses and all of this tied together to come into this. What's been an absolute unbelievable thing is GMI is provably the best performing research service in the world, because we've had a track record that's been recorded for 20 years. Long may that continue. We've had our up years. We've also had a few down years too. But anyway, a framework like this has kept us on the straight and narrow. So let's kick off. The key thing, I've been an investor for a long time, as has Julien, and we've run diversified portfolios. That's what we've been taught to run. We now believe that diversification is dead, and the best thing is hyper concentration, which goes against what many, many people will tell you, but we'll explain why. And it all comes down to the biggest macro variable of all time, the most important. And I'll explain why this has happened. But what the issue is here is the global governments and central banks are increasing liquidity to manage debt at 8% a year. 8% a year is actually the devaluation of fiat currency that you don't see. It's kind of hidden, and we'll come into how it's hidden later. But this 8% is your hurdle rate, plus you need to add inflation. Yes, it's in addition to this, because inflation is not the same as debasement. So you've got an 11% hurdle rate on any investment that you have. And once you understand this, it changes what you do with your money. Because don't forget, an asset that you buy is future deferred consumption. Some point in the future, you want to release that. And because you've locked money up for an extended period of time, you expect to be rewarded above what is happening to debasement or inflation. That is the whole point of investing. Now, what is happening is most things aren't doing that. We'll come into that. So anyway, just remember this, 11%. If your investments are not hitting 11%, you are getting poorer. Okay, the everything code. It all starts with this, the magic formula. The magic formula is how you think of trend rate of GDP. It's actually driven by population growth, productivity growth, and debt growth. Those are the three key factors that drive GDP over time, and it's consistent everywhere in the world. So let's start looking at these. Trend rate of GDP has been falling over time since the 1950s and is now around 2%. Okay, so why is that? Well, the working age population has also been falling. So the working age population means that it drives less economic activity. So the trend rate of growth there has been falling too. Also, productivity has been falling over time, which is extraordinary considering the technology revolution that we've had. It has not driven productivity as much as it could have done. Yes, the measurements aren't great, but also it's a factor because of an aging population, and we'll show that shortly. Debt growth. Well, debt growth appears to have peaked back in, let's say, 2009. We had the pandemic spike, but really it has been trending higher over time, and the structure of debt has changed over time. You see, private debt, the private sector's been deleveraging. It's now down to about 100% of GDP. Total debt is still about 340% of GDP. When we get to private debts, it's about 120% of GDP and has been falling, which is good. But total debt has offset it, the public debt. The government has actually taken on the debts as the private sector's delevered, because it's trying not to let the deleveraging slow down GDP any further. It has increased debt. Okay, so that's how the three dynamics play out. But let's look at the most important one of all, demographics. Demographics is the basis. When I first started GMI, the first article I ever wrote was Debt, Demographics, and Deflation. And that has been my framework ever since. So let's understand demographics. The US birth rate per 1,000 people has been collapsing over time. It is more pronounced in other nations. It's definitely more pronounced in Europe, China, Japan. So the Western world has basically the same issue, which is the growth of population, which drives GDP, has been falling. And that means that we can forecast into the future because we know when people become labor force participation rate, or they become part of the labor force. Now, for some reason, it's a 16-year lead. Maybe you could shovel it and make it 18-year lead. But really what we find is that demographics are destiny. They forecast where the labor force participation rate is. The labor force participation rate is the key thing for economic activity. So what we've got ahead of us is a trend rate of labor force participation rate declining. And what this chart shows, this is like the most important chart of all of macro, and I've never seen it produced anywhere else ever, because I don't think people understand it. This is the chart of the labor force participation rate versus government percent of GDP inverted. So what it shows is trend rate of GDP is basically offsetting the labor force participation rate fall as the population ages out. That is why we have a debt problem. That is why government spending is so hard to manage. It's because we have this aging population. That is the key to everything, and it's only going to get worse because of this. So this suggests out into the future, debt keeps going up. Now, the economic singularity will change this at some point, but we've still got this collapse in the labor force participation rate to deal with into 2030. And that's going to drive massive increases in debt to GDP.
Raoul Pal draws attention to the persistent devaluation of fiat currency as a key factor influencing global wealth. Every year, household income increases by just around 2%, but purchasing power declines by approximately 11%, a disparity that subtly contributes to growing inequality. Because of this imbalance, real wealth can no longer be preserved by conventional value stores like cash, bonds, or even large equities portfolios. Investors need to own long-duration, scarce assets that increase in value more quickly than fiat currency diminishes in order to stay ahead. In the current environment, that means technology, and most importantly, cryptocurrency, with Bitcoin leading the way. Pal's message, however, goes beyond using Bitcoin as a simple inflation hedge. According to him, it is a component of a structural revolution, a network-based system that, like the early internet or Amazon's ascent, is intended to compound value through widespread use. He contends that the expansion of cryptocurrency follows the fastest adoption curve in history, making it the main force behind wealth creation for the ensuing 10 years as well as an investment class.
You see, these are in perfect mega trends. The labor force participation rate is in a beautiful log regression channel, and we should just move towards the bottom of the channel and beyond in the coming years. And the reverse of that is the government debt percentage of GDP. You can see them pretty clearly, the trend. Now, the next thing that we found that nobody else has found is that Fed net liquidity, which is the use of the TGA, the balance sheet, and the reverse repo, has been the main mechanism for financing the debt. So they're joint at the hip. And so what they're doing is using liquidity to finance debt. If we do this on a globalized level, it's actually global total liquidity that is the real answer to all of this. But that you show how close that correlation is. Yes, the axes are different log scales, etc. But honestly, don't mid-curve it. This is the key thing. They're using the balance sheet plus any monetary tools possible, including the banking system, to pay for the interest on the debt. So you can see total global liquidity. They've started using the banking system as part of this. So that's why we've started switching our key measure to total liquidity, not Fed net liquidity, because it includes M2 and other measures. And you see what's happening there is it is starting to rise, as is the debt to GDP again. Now, what's interesting is when we look at the interest payments, you can see that it's the liquidity that pays the interest payments. The interest payments, because interest rates are above trend rate of GDP, that needs to get monetized because there's not enough economic activity. If the trend rate of the economy is, let's say, 2% and rates are at, let's say, 4%, well, that's double the amount of economic growth to pay the interest. We don't have it. The government's 100%, 120% in debt, and the private sector's the same. So there's just not enough economic activity to pay the interest on the debts. So this is why they debase currency. It's the story as old as the hills, but it is incredibly important to understand. Try not to mid-curve this and overanalyze this, because this is what is going on. Why did it happen and why is it happening? As I said, it's not the first time it's happened. It's actually happened in the 1950s, and it's happened in the past too. But to understand it all, you'll understand that since 2008, everything became ultra cyclical. Before then, we had a business cycle that shifted a lot. It wasn't as clear. There was much more diversification in investments. But since 2008, everyone's like, oh my God, everything is a bubble all the time. And it's all driven by this one thing, the servicing of the debt. You see, back in 2009, well, 8-9, every major government around the world gave themselves a debt jubilee. They paid zero interest on any debt, and most of the private sector got to zero interest as well. That allowed everybody to restructure debts. The private sector has been paying it off. The government has been increasing to offset that. But what they've done is they've created a 4-year cycle, or they had created a 4-year cycle. We'll come on to the shift in that cycle based on the debt refinancing cycle. So it's about a 3 to 5 year sector is where they've been operating at. And every 4 years, they've been basically refinancing that debt by printing money. And that happens over a 3-year period. And then there's usually a period where they withdraw money from the system before they start again. But each time it keeps going up. And that creates these weird cycles.
Raoul Pal brings everything together by demonstrating that the growth of cryptocurrency is a data-driven, parallel rather than a conceptual analogy to the internet. The adoption rate of cryptocurrency has been about twice as fast as the internet, which grew at a rate of 76% annually before maturing at a rate of 43%. By 2030, half of the world's population may possess a cryptocurrency wallet, signifying billions of individuals using blockchain networks for transactions, savings, and construction. This time, the main distinction is ownership. Unlike the internet, users possess tokens that allow them to do more than simply access the system, while Ethereum, Solana, and other smart contract platforms create the new infrastructure for payments. Tokenized assets, AI-driven finance, and stablecoins. Bitcoin becomes the digital equivalent of gold and may even compete with its $20 trillion market. Global settlement systems may change as a result of this silent replacement of conventional financial infrastructure. Now, demand for the U.S. currency may even change. Governments and big organizations like BlackRock may try to control or absorb this change. But the decentralized structure of blockchain guarantees that its fundamentals will never be stopped. Ethereum's open apps cannot be closed, and Bitcoin cannot be confiscated or inflated. Pal believes that this is the most potent macro trade in contemporary history. Crypto is still 4% of the way to his estimated $100 trillion valuation at $4 trillion, which means there is still a ton of space for growth despite inevitable cycles and volatility. The takeaway for investors is straightforward: comprehend the calculations, have faith in the network effects, and support the forces that outweigh devaluation. As digital ownership and exponential adoption change the entire structure of global banking, those who do may see the largest wealth transfer of the century.